my God, where in God's green earth do you invest today? I know where to your heart is through blockchain and crypto. It's interesting. I'm probably a little more conservative, but where do you invest today? It's killer out there because you look historically a 60-40 portfolio. Think 60% equities traditionally, or more aggressive stuff, 40% debt, or your anchor to windward to bridge those times when your 60% isn't doing so well. And historically, that's outperformed everything. But you look at the market today, oh my God, you say, all right, the 60%, look at equities. Frothy, we're talking really peppy. The Case-Shiller PE index is 33% higher than it's been in the last 20 years. That could give one pause. The Fed, the markets are awash in capital. The Fed has a $7 trillion balance sheet today. Wow, huge. Look out below. And you see other kind of goofy stuff. Tesla's up 800% in January. 25% of the market volume was retail. And you saw nitwit stuff like GameStop, AMC, and all of that stuff distorting. I mean, come on. You saw trading in Hertz, filed for bankruptcy. People are buying it. Come on. Hello, there's no value. So you've got equities that are really challenged. I'll give you one, having had a web company that stuck in my mind. The IPOs have greater losses in the last 12 months than existed in 1999, the height of, the web boom. Oh, got to give one pause. All right, so you say, well, that's challenging. I think there's solutions. They're not easy. Now, let's look at the other side of the equation. The 40% that is your anchor to windward, traditionally intermediate grade bonds. I think you have to have your head examined to have intermediate grade or longer duration bonds. Why? There is asymmetric risk. In the 80s, interest rates were around 16%. They've fallen today, 10-year treasury, let's call it around 1. Can it go much lower? The Fed has said no negative rates. So the answer is no. So what's the probability? It goes up. Already this year, if you bought the 10-year treasury bond, you're in a loss position. Not too encouraging. So what the hell do you do with fixed income? I think it's a challenge. Perspective. Inflation is running higher today than the 10-year treasury bill. So value destroying. So what do you do in that bucket? I will share some ideas because there are alternatives. I think there are some pretty nifty ones. All right, pulling the camera back a little bit. You look at this picture and you say, all right, what do I do? I think niche investments. Well, what's some of the really smart money doing today? The Yale Endowment has probably one of the best investment track records out there. Here's a shocker. 89% of their capital is in alternatives or real asset classes. Harvard, no slouch either. About 60% is in alternatives or real assets. Now, benchmarking. The average pension plan over the last 20 years generate about 6%. CalPERS is probably the largest. 10-year track record. They have a, by the way, this is almost hilarious. They have a bogey, Joe, of earning 7%. The last 10 years, they've earned 472. Now, I hear investors say to me, I'll never forget this. I was on an airplane flying to New York a few years ago, and I was talking to a guy sitting next to me. He said, Alan, I don't get out of bed unless it's a 25% return. I'm looking at him like, give me a break. It doesn't happen. And I said, I'll tell you what, I'll give you a 7-digit check today if you can prove that you generate a 25% return. He got very quiet. The conversation came to a stop. All right. What's the critical thing I believe in investing? All right, Joe, here's a fun question for you. You're a hotshot. What's the 8th wonder of the world? There's 7 known ones. What's the 8th wonder of the world?
I don't even know.
Compound returns. Generating losses destroys investment performance. So I would argue you want to grind out a consistent rate of return because your performance will be better than any of those pension plans who can buy any kind of investment advice because they're rich. And so I would argue you want to grind out a consistent rate of return like Yale, like Harvard, and people like that. Now, one of the things, given your misbegotten youth, when you were living in Puerto Rico, we'll talk about Puerto Rico at some point. But if I were to look today, and yes, I'm prejudiced about this, what I think is an outstanding, off the beaten path investment for that 40% bucket. All right, hold on to your knickers. It's investing, lending money against museum quality fine art. Here's the trade. Lend money against, I don't know, a Rothko painting, a Greco painting, a Damien Hirst maybe, something with pedigree for a 1-year term loan where the borrower pays the insurance costs and the borrower pays, now this is critical, this warms my black heart, where the borrower pays the storage costs. Why? Because as the lender to this borrower, we keep the collateral in a bonded art warehouse. Think about it. This is hard asset lending where you control the underlying asset. You don't pay, guess what? We're going to sell the art. Now you're going to do it at basically a sub 50% loan to value ratio. That's less than most real estate deals. Now, why does Alan fall in love with this hard asset class? You think about the collateral. Compare it to lending against all the securitized auto finance. I know you like mortgages. We'll come back to that. You lend against a damn car, the value depreciates like a house on fire.
And the car has wheels. Wheels, so get away from the lender.
Yeah, equipment, same thing. And you don't control the car or the equipment. You have to go repossess it. And you have all those guys, have some fame repossessing cars. With art, pretty neat. Art moves around the world like gold with currency fluctuations. Art's transportable. I buy an apartment building in LA where I live. Fine, as long as the LA market is doing well. If it isn't, I'm toast. I can't move the building. Art, I can move. If the US market's poor, I can sell it in Hong Kong, Abu Dhabi, London, or wherever. That's one great characteristic. Here's a second. Art over the last 50 years has appreciated around 8%. High-end art, museum quality art. Last 20 years, a little less, about 5.5%. So what does that do? That gives you, which I like, being a nervous Nelly, more room to be wrong. Okay, that's good.